Hello, this is Beast McFeast, and today we're going to go over how to start investing or trading stocks, whatever your preference is. It's not really hard to get started, though it can be difficult to do it well, but that can come later. Just like with most things that are difficult at first, once you've executed a few trades, you'll find that it gets easier and easier with time, and the fear of just going through the motion will disappear. Now, I'm going to be honest about it. Investing in the market does have risks, and we're going to discuss some of these. You'll want to think about your risk tolerance before jumping in because there is a chance that you lose some or all of what you invest depending on how you do it. The first thing you're going to have to do is to open an account. You're going to do this at a brokerage, an investment bank. There are many brokers to choose from with different qualities. Some popular ones are TD Ameritrade, E-Trade, M1 Finance, Fidelity, Robinhood, and Webull. If you decide to fund an account on Webull, go ahead and use the referral link in the description. This helps me out and will allow you to receive some additional free shares of stock after you have funded your account. For ease of use, I'm going to say Webull and Robinhood probably come out on top, although the other ones are fairly easy to use. These two have really great phone platforms. A lot of people do their trading or investing just on their phone using these two. Some of the more serious brokers that I would trust with larger amounts, really, would be TD Ameritrade and E-Trade and Fidelity. They are large, well-established banks that aren't really going to go anywhere. M1 Finance is an interesting choice because if you're going to be a long-term investor, it really gives you a good, great display of how your investments are broken down. It's very pretty to look at, really. Now, after you've chosen your broker, you're not going to be locked in forever. I mean, you can change later. It takes about a week to move all your holdings over, and it might cost you about $75 to do that, though the receiving broker will often reimburse some or all of that, depending on the size of your account. When you're signing up for an account, you'll have to make several decisions, such as if you want options privileges, if you want to enable margin, and if you want to enable buying crypto. Some brokers allow you to buy and trade crypto through them. For me, when I signed up for an account, I decided to enable all three: options, margins, and the ability to buy crypto. I just wanted to have that ability should I decide to use it. And for some more complex strategies, you do need to have the ability to use margin, although you never actually have to use it. You just have to have it as a backup. You will then have to fund the account, and this typically takes several days. I mean, a lot of brokers have an option to do it faster, but it'll cost you, and I don't really want to pay money to move my money wirelessly like a day faster. So I just wait a couple days to get it moved. It's fine. And that several days it takes for your money to move might be a good time for you to consider your investing goals and strategies. Some strategies you might use are investing or trading. Those are the two broad categories. Investing is more of a long-term outlook where you intend to hold things for multiple months or years or your entire life. And that's a fine way to go about it. Works for plenty of people. Trading can be done intraday, where you move into and out of a position in the same day. This is known as day trading. And you will be somewhat limited on doing this depending on the size of your account and whether or not you have margin enabled. Swing trading is trading along the time frames of multiple days to a couple weeks, essentially, maybe up to a month, where you move in and out of positions relatively quickly. If you intend to day trade, you're going to need a margin enabled account with a balance of at least $25,000. Otherwise, you'll have a limited number of day trades, or if you're not margin enabled at all, your funds won't clear in time for you to day trade. So you'll again have a limited number of day trades just for a different reason. If you have a margin enabled account and you want to day trade and you have less than $25,000, if you were to do more than 3 day trades in a 5-day period, your account will be locked for a period of time, which, makes it really difficult to trade. As I hinted at earlier, there are some brokers who might work a little better for some strategies than others. So if you wanted to get into like complex option strategies, well, you'd want to look at TD Ameritrade or Tastyworks. If you want to have day trading in the palm of your hand, you're looking at probably Webull because Robinhood charges you for margin, and That's kind of ridiculous. They charge you up front for something that they're going to charge you an interest on later. I wouldn't mess with that. But some people do. And for long-term investing, M1 Finance looks really promising, although any of them really will do long-term investing just fine. So if you're still watching and you found this at all useful so far, go ahead and like and subscribe or let me know in the comments. Let's continue. So what are some of the risks of investing? Obviously, the market does not always go your way, especially when you're new to it. With that in mind, it's advisable that you don't invest more than you're willing to lose, and that you do not invest money that you're going to need immediately or in a very short period of time. Especially at first when you really don't know what you're doing, because it's such a broad subject that you could study it for a lifetime and still learn new things. And on a special note for risk, if you're using margin, you could potentially lose more than you put in. So what margin is it is an ability for you to take out a loan in your account to spend more than you have in your account. So you could buy $10,000 worth of stock even though you only had $8,000. And if for some reason that company went to $0, you would owe the difference between what you had and what you bought, which is not a fun position to be in. Now, there are other ways where you might get a margin call that are less serious, in that it's just an accounting error that resolves itself in the next 24 hours with a phone call. But it can still be a stressful position to be in. So until you understand margin well and how you might use it as a tool safely, maybe don't use it. For the first several years of my trading, I didn't use margin. I just had to have it enabled to do a lot of trading. You're really going to want to do some research into whatever you're doing before you start. And what you want to research is going to vary depending on your intended trading or investing style. Traders probably want to know how to read the charts. So you want to look up technical analysis. There are videos and books that can aid you in this. This helps you to identify trends based off of what the chart is doing to help you pick entry and exit points for your trade that you move in and out of rapidly. And for this, it doesn't matter so much like if the company is a great company or if the ETF is a great ETF in an awesome field that's growing. It's more of, can you read the chart and get an idea of what's going to happen in the next 30 minutes, hour, that sort of time frame. If you see yourself as more of a passive investor, you probably want to look at the total returns on ETFs over the past several years. Now, past performance doesn't guarantee future performance, but it really is the best thing we have. Unless you know for certain that some sector of the market is going to grow remarkably in the next few years. And then you could invest in that sort of ETF. And I'll recommend you take a look at my video, which I'll link to with the card at the top, about how to go about using growth ETFs to help you retire early. More active investors might be more interested in buying individual stocks, and you might want to look into fundamental analysis in combination with technical analysis. Fundamental analysis is essentially looking at the financial health of companies and their place in the marketplace to gauge whether or not they're priced appropriately. Obviously, if you find a company that's priced below where your fundamental analysis says it should be, you would be inclined to put some money in it on the bet that it would go up. And over the long term, this can be remarkably profitable. If you get good at this, you can beat the market. If you do want to invest in individual companies, and maybe you aren't the best at fundamental analysis or technical analysis, you can invest in companies you believe in. If you work in an industry and a new company's products keep showing up in your industry, there's a good chance that's a growing company and you could profit on that. And it's a good idea to stick to your area of competence. This is from Warren Buffett. You don't want to stray too far from the things you understand. So essentially, the greatest investor of all time recommends not investing in things you can't figure out yourself. To place your first order, you really want to be familiar with the user interface of your broker or trading platform. So what I recommend is you play around and explore. Look at multiple tickers, open up charts on different time frames, see what you can, if you can scribble on the charts with your mouse or finger. See what the different pages say and what different options say they do. Just play around without placing orders until you feel comfortable with whatever platform you're on. And then, when you're ready to trade, think really hard about it first. You want to consider what's your exit plan. If you're a trader or investor, you have different time frames here, and your exit plans might be different. A lot of people like to place an order that would limit how much they lose if they happen to be wrong on an investment. It's a pretty good way to go. Maybe limit your losses to 10% or 5%. And on that note, you really want to learn the different types of orders and how they work. And I'll be making another video on that shortly. Because there are several different types of orders that can help you to buy or sell at certain prices while you're not even present in front of the computer or phone, which is nice for most of us because we can't just sit here and watch it 8 hours a day. And when you're first getting started, and when you're more experienced, it's probably a good idea to trade small for most people. Small being as a proportion of your account. Maybe don't go all in on a ticker that you think is going to be the next hot thing unless you have a really great reason to think so. And if you do, let me know in the comments because I'd like to know it too. And you might consider paper trading. There are some platforms that allow you to practice trading. One of these is TD Ameritrade. You can do it on their Thinkorswim platform. I think Investopedia also has a similar function. Now, paper trading is not the perfect substitution because some realities of the market don't translate well into it, nor do you experience the psychological turmoil of having your money on the line and slowly disappearing or growing rapidly. It takes a while to get used to that and to not get too greedy with things. And finally, you really want to learn more and improve. This is going to be a lifelong journey if you stick with it, and asking others or seeking advice is advisable because learning all the things there are available to you to learn by yourself is going to be hugely expensive. There's plenty of mistakes that other people have already made that you can learn from. And remember, anything that seems too good to be true in the market definitely is. There's no free money trick, no matter how promising it looks. I promise if you crunch the math on it, it won't work. That being said, if you're really good, you can extract a lot of value out from the market. Thank you for watching. Good luck. Get rich. Bye.